As we continue through chapter 1 and talk about different concepts with business and different kinds of businesses, on this slide you can see we have different business types. So the first business type is sole proprietorship. A sole proprietorship is where one individual opens up a business. This is one of the single most common types of business. They are not separate from their business. So where we look at this different kind of thing where it says business taxation, owner liability, and legal entity. Well, a sole proprietorship gives you unlimited liability. This means if you have a sole proprietor, you own your own business, and someone sues you for some reason, they can come after your personal possessions. So they can come after your house, after any money that you have. That's what that liability talks about. A partnership is generally set up a similar way. So in a partnership, you have 2 or more people. You can have 100 people in a partnership and it's still called a partnership. It's really about the structure of how the business is taxed and the owner liability. A partnership also has unlimited liability. So partners are jointly responsible for partnership debts. So this would be if there's any debt of the company gets sued and loses a lawsuit, all of the partners are responsible. Now, a corporation and a limited liability corporation, these have limited liability. In these cases, the business is separate from the owner. So the business is separate from the owner. They have limited liability. Only the business is liable if something should happen. So for the debts of the company, or if the company is sued, it stops at the business and only the business would have to pay. Something to know about the limited liability company, or the LLC, is that you can create a sole proprietorship and partnerships as LLCs in order to help with that owner liability. In fact, it's highly recommended that if you're setting up your own business, that you do the additional paperwork with the state. I think with the state of Iowa, it's $25 to register as a limited liability company. I highly recommend that you take the extra precautions if you're going to start your own business and have it incorporated as an LLC for that limited liability protection. Corporations, we're going to talk about a lot. We're going to have a whole chapter where we talk about stocks and corporate ownership towards the end of the semester. So corporations are anyone that sells stock to the public, also called publicly owned businesses. Okay, we're going to continue with our accounting discussion by talking about different accounting principles. So first, we have an accounting constraint. These different constraints are similar to assumptions, which, so the first is a cost-benefit constraint. So this is one of those things that applies a lot more often in managerial accounting than it does in financial accounting, but it can still apply. So we have the rules that say that we have to provide information to decision makers. Well, within those rules is this cost-benefit constraint that says only information with benefits greater than the cost. So that means the benefit of the information to the decision making was greater than the cost of collecting that information. Okay. Then we have the materiality constraint. So only information that would influence the decisions of a reasonable person. We're going to talk about materiality with other components as we move through the course. Another concept of materiality is size. So when do we have to report something? When do we have to do certain accounting treatments? Well, the official accounting rules say only if it's a material amount. The problem with this and the difficulty of this is what is a material amount can be different to every single company. A small company might think that $1,000 is a material amount, where a very large corporation would not consider $1,000 a material amount. So that decision about what is or isn't material in the accounting realm of information really depends on the size of the company and what they have set as what is material or not. Okay, and then we have conservatism and industry practice. So conservatism is really a fear of taking risk in the business world. So we're not talking about conservative politics here. We're talking about being conservative in risk-taking endeavors. So whether I want to launch a new product line or just maintain the products I have because I'm risk adverse. Industry practices where we're competing within an industry, and so we are constrained by the industry and what the industry requires or what other people are doing. This can also be included as a restraint. The next item that we're going to talk about is the accounting equation. So the accounting equation is set up of the accounts within an accounting system. So we have three main types of accounts. We have assets, which are things that the company owns. Assets include cash, buildings, inventory. Then we have liabilities. Liabilities are money that the company owes to other people. Whether we have a mortgage that we have to pay because we don't own our building yet, we owe our employees money because they've been working with us, we owe our suppliers money, and then owner's equity. Owner's equity depends on what is inside. Owner's equity depends on what type of business you are. If you are a sole proprietorship, which means you own the business outright, the owner's equity is any money that you personally put into the business to start the business and get it running. If you're a corporation, owner's equity consists of the stocks and stock information that you have sold stock and received money for it. In the accounting equation, assets always equal liabilities plus owner's equity. So if for some reason at some time this equation is not true, there is a mistake in the accounting records. So this accounting equation needs to be true at all times. Assets equal liabilities plus owner's equity. So we're going to look at some of those items. Now, as you can see, the equity we can expand out into what we call the expanded accounting equation. So the equity is a component of contributed capital, so either common stock or what the owner has contributed, and an account called retained earnings. Retained earnings is what you have left over after you've paid all of your expenses. So what is the net income? Then you can have retained earnings that will build up. So it's last year's net income plus this year's net income plus next year's net income, unless you should spend dividends out there. But don't get a lot of these terms can be new right now, but we're going to be talking about them a lot. What we're going to be focusing on right now is just how transactions affect the accounting equation. So I'm going to pause right here, and for the transactions, I'm going to start another video so that these videos don't get too long.